Welcome back. You're watching The Money Show. Equity markets have remained highly volatile in the recent times. The rise in volatility has spooked retail investors who are now contemplating whether they should stay invested or take their money out from their equity investments. We asked these questions to Nikunj Dalmia, Managing Editor, ET Now Swadesh. Listen into this special interaction. All right, Nikunj, welcome to Editor's Take, and today we're going to talk about how in the past 2 years, or specifically talking about 1 year, people have not really made money in the market, but mutual fund investors, and especially the ones who are investing through SIP, have really made good amount of returns. So I would first like to understand the kind of maths we are talking about over here. Last 2 years, I think 17%, but last year only 5% return, I guess, from the market?
Kavita, if I look at the market return from broadly from October 2021, it's about good 18 months now, the market return has been flat. It's almost been a flat line.
Right.
And if markets have given a flat line return, obviously mutual fund returns in last 18 months, in a sense, have not given you very satisfactory returns.
Right.
Post-COVID, the expectations got spoiled. Everyone thought that 2021 and 2022 returns will be there for eternity. But ultimately, we must realize that equity as an asset class, A, will never give linear returns. B, if the returns are front-ended, the next couple of years you may get negative returns or you may get low returns, so that it actually averages out. Equity as an asset class, and especially if you are looking at not individual stocks, but if you're looking at investing by the mutual fund route, will always give you a premium to the fixed market return. So the fixed market return, or the fixed income return right now is at 7.5 to 8%. In that you will add an equity premium. That could be anywhere between 3 to 4%. So for anybody who is now looking at future returns, the future returns should be anywhere between 11 to 14%, depending on your entry point. That should be a realistic expectation. Now you may not get 11% every year, but you may get 30% in 1 year. So I think that is what we need to understand, the kind of equity markets we are in, the kind of equity market returns we have seen, and the kind of equity market returns one should be expecting in the near future. The challenge now, Kavita, is fixed income as an instrument is giving you decent returns. So if you are a near-term investor who says, look, I've got a 3-year time frame, not beyond that, I want to lock some fixed assured returns, and you've got capital which is less than 3 years, then I think it really makes sense to look at fixed income products. So it's a perfect, it's a perfect timing to perhaps move your fixed deposits into fixed income right now, because the fixed income market, I don't think, will give you this kind of an attractive return for a long period of time. And that is where I guess the whole dilemma is there now. That should you go for fixed income or should you go for equity returns? Should you go for equity as an asset class?
But then we definitely can't replace this. We need to follow the proper rule of asset allocation, diversification. But talking about SIP, now what is the magic trick that we are seeing, especially for the SIP investors who are seeing return in their portfolio in specific categories, though? If we talk about small cap, thematic funds apparently are also giving good returns, decent returns, I would say. What is this? Is it the fund manager's intellect? Is it their strategy which is actually showing in the fund performance?
So without getting into whether a fund manager is getting the strategy right or wrong, let's understand thematic funds. Thematic funds are high risk return funds where you essentially may take an advantage if you take some tactical calls. For example, that if India's GDP is going to grow at a substantial, is going to grow. So banking as a sector will do rather well. Why? Because CAPEX has started, corporate balance sheet is expanding. So for next 2 or 3 years, you say that a banking fund will outperform. Similarly, if the US economy is in some kind of an grinding pain, then IT as a category is going to underperform, and that's what we've seen in last 1 year, how the IT index is actually underperforming. So the IT thematic fund may not give great returns. So if you are a complete plain Jane investor, you say, look, I want to bet on equities. I do not want to pay too much of commission. However, I want to be part of India's growth story, then go for index funds. You may throw in a little bit of diversification, go to mid and small cap funds. If your risk appetite and the time horizon allows you to expand slightly more, then you should go for thematic funds. Just like we say in, there's an old saying in English that one shoe does not fit all.
Right,
So I think that is
exactly.
the category.
Yeah.
But the broader conversation what you and me should have right now is that is it time to panic for SIP investors because
Exactly,
you've not got
yeah.
any returns.
Yeah.
But my limited point is that look, SIP is something where you cannot think in terms of quarters, months, or 2 or 3 years. If you have a time horizon which is 5-year plus, so when the market goes through this lull period, you will actually start accumulating more units. That's how the dollar cost averaging works. I'm not saying anything new. So when the markets will come back, the number of accumulated units what you will acquire in this lull phase of the market are the ones which will actually start creating extra wealth to your portfolio. So if you are in for 3 years, 3-year plus, I guess you have to have patience. What I've learned over the years, when I speak to people from my personal experience, there are 3 things which will help you create wealth. First, believe in India, that tomorrow will be better than today, and day after tomorrow will be better than tomorrow. I think I have that inherent belief, you also have that belief. So the big picture argument stays with us, that you want to bet on, rise with India, like we said, ET now, rise with India. Second, you do not need too much of, you don't need too much of skill. The only way to make money in equity is to have patience. So there is no IQ required.
Yeah.
It is only patience.
Totally. Yeah.
PQ, patient quotient, right? And third is believe in the power of compounding.
Yeah.
I'm saying something simple, but that is what works.
Oh, that also we are seeing in the SIP data because the figures have crossed almost 13,000 crores. The people are continuing the SIP, but somewhere down the line, the conviction to continue it in equity or maybe allocation between within equity only. You know, talk about large cap, mid cap, or small cap. Where do you think they can actually go heavy, or they can, you know, reduce and maybe go into fixed income? What should be the asset allocation right now? Because large caps are not performing clearly. Valuations are not really right for mid caps and small caps also. So how should we diversify within equity?
So Kavita, as a theme, I think banks will do well now.
Okay.
So I think it makes sense to perhaps, let's say, buy a banking fund run by a good AMC. Because for the next 2-3 years, the economy is going to grow, credit growth is going to grow, banks have got a good balance sheet. Even the banks have given a good return in last 1 year. I think banks as a category is a large profit pool, which I think is staring at us. So it makes sense if you are a high risk, if you have a slightly high risk appetite to buy into a thematic fund, let's say in the banking fund.
Yeah.
Then you come to the small and the mid cap. This really again has to be in part of allocation if you're ready to take that risk.
Exactly.
If you look at historically over the period of 5 to 10 years based on previous data, yes, small and mid cap stocks in patches they tend to give you outperformance.
Right. Right.
And then is the classic large cap equity diversified scheme.
Yeah.
My only challenge is that last 3 years have taught us that unfortunately the funds do not have a very great track record of beating the benchmark.
Exactly.
So when it comes to large cap and when it comes to keeping it simple, I would always say go for an index fund. Your first purchase.
I was coming on that. Yeah.
Your first purchase as an individual for yourself.
Yeah.
For your family, for your child, I think it should be an index fund. I'm a big votary of index fund.
Yeah.
The first step should not be complicated. So, first fund अगर आप ले रहे हैं, तो don't buy a thematic fund, don't buy a small cap fund, don't buy a equity fund, don't buy a mid cap fund. Start with basic index fund. Whatever folks will come and tell you, index fund ultimately have a strong track record. So you are not going on somebody's intellect, you are not going on somebody's process. All you're saying is that I'm bullish on India, I'm betting on India by buying an index fund.
Right.
Then is the diversification mantra which comes in.
One more thing, which is also there in news a lot, and we've also covered on the channel as well. BAF, Balance Advantage category, which was apparently doing very well, by the end of 2021. Suddenly, we are seeing that particular trend being followed in multi-asset allocation fund. Now, what is the reason behind that, and why? Because Balance Advantage category is something that gives you a proper exposure in equity and debt also. 65% or so goes in equity though, but then the fund manager has the liberty to rebalance it. Why is that category not doing well, and multi-asset allocation are like picking up like hotcakes?
If you've seen a roller coaster,
Yeah.
I think markets are like a roller coaster. Up, down. What a Balance Advantage fund does is that it gives you the ability to ride through the ups and the downs of the market.
Right.
So that is what a Balance Advantage fund would do. Unfortunately, last couple of years have been hard for the economy on the macro front, and yields have actually gone higher. So the Balance Advantage category has not really given the returns what the historical returns really have been. But at the current juncture, if you frankly ask me, does it make sense to have a debt exposure to your portfolio? Now, I'm a hardcore equity guy. Because I believe in the power of equity. Equity will continue to beat all asset classes going forward, and there is enough and more data which the minute you expand your time horizon, Kavita, equity will always do well because you're taking risk and you have time to your advantage. So when you have time and ability to digest risk, equities. But I think we are at this juncture of the economy that it makes sense to lock some capital into fixed income products because fixed income rates right now are attractive. And a year from now or 12 months, 18 months from now, interest rates will be lower and they will peak out in this year. If that is the template you want to play, then I think it makes sense to lock some capital into fixed advantage, into fixed income, because you're not locking them at 6%, you're not locking them 7%. Now we're looking at 7.5%, 8%, even 8.5% returns, which could be projected returns.
All right, so time to continue your SIP and also, if possible, try and increase the amount of your SIP. This is a time to accumulate units as much as you can. What will you say?
First thing is don't cancel.
Don't cancel.
Don't look at last 18 months and say, okay, I've got no returns. That means my equity planning, my SIP planning needs to be changed. All I'm saying is that it is time to understand the nature of the market. Nature of equity market is that they do not give you linear returns. Do not have extraordinary return expectations. But if your return expectations are anywhere between 12 to 15% or 13 to 18%, you will get them. But you may not get them in 1 year. You may get 40% in a year, and you may not get returns for next 3 years. That is, I think, what has happened post-COVID. The returns have been front-ended. Now markets are taking time to digest it.
Okay. All right. So things you have to note down: do not cancel your SIP, maintain the discipline in your investment, and also do not miss out the opportunity of investing in fixed income. Thank you so much, Nikunj, for being on the show today. All right. So that's your take on your investments in equity and fixed income. But now